in just a minute. Once again, all the attendees are muted, just in the interest of sanity on everybody's line here, so we don't hear a bunch of background noises. First and foremost, let's go through the agenda. So today we're basically going to focus on the topic of Section 125 plans. Specifically, want to drill into the tax implications of these plans, a little bit on the employer and employee sides, and certainly focus on the tax advantages. We're going to go through some of the plan rules, discuss compliance issues, what can and cannot be offered, who is eligible, go through some of the eligibility rules and testing. Some quick introductions here. For those of you not familiar with payroll systems, we've been a leader in services such as certainly payroll, time and attendance tracking, consumer-directed healthcare plan administration, as well as complete human capital management platforms for well over 25 years now. Our clients are anywhere from a single employee up to 1,000 employees and more. We're truly just a complete workforce management company. I'm real pleased to introduce our guest speaker today, and that's Toni Bitzeff. Toni's an experienced ERISA attorney, and she's also the founder of West Coast Benefit Law. Toni's been working in employment benefits for the past 20 years, and we are very, very thankful to have her taking some time out of her busy day to be with us today. And Toni, with that, I'm going to go ahead and turn it over to you so we can get into the webinar. I'll click on the first slide here for you.
Thanks, Matt. I'm excited about talking about 125 plans today, and most people would think that's because I'm a tax nerd and a benefits nerd, but it really isn't. Well, actually, I really am a tax and benefits nerd. But the reason why I'm excited is because 125 plans, also known as cafeteria plans, offer so many advantages to employers and employees there, and can really do a lot to make sure that you're getting the best return on the money that you're spending on employee benefits. Also, they're very misunderstood with a lot of confusing terms, and so that way I get to show off and show that I know something. So those are the two reasons why I'm excited about 125 plans, but we're really going to focus on what they can do for you and how you can get the best value out of your benefit dollars by using 125 plans. So 125 plans have been along for a very, very long time. They were added to the Internal Revenue Code back in 1978, and the reason they're called 125 plans is because that's the code section that they were added to. I really like, as much as I like cafeteria plans, I really don't like the name. First of all, because I don't think 125 means really anything to most people, and also cafeteria plan presents a strange image. But basically what cafeteria plans do is they allow people to buy using pre-tax dollars. That's really the gist of it, and we'll get into more of that. But they're a tax tool. They're not actually providing the benefits themselves. They're just allowing the use of pre-tax dollars to buy benefits or a selection of benefits. There has been a lot of guidance over the years on 125 plans. Most of the guidance has not come to the level of being formal regulations. From a legal perspective, a formal regulation has more deference. It has more of an effect than the informal regulations that we have that has come from the IRS. Formal regulations have to go through administrative process, and then they don't quite get the same effect as an actual Internal Revenue Code section, but they come very close. We did have proposed cafeteria plan regulations that were issued in 2007, and they were never made final. This is both good news and bad news. It's good news, those proposed regulations. The IRS, or a group of people at the IRS, threatened to be very strict about application of these rules and to impose penalties on employers who didn't follow them. They went doing a kind of dog and pony show and threaten to bring sanctions within a period of time after finalization. Since the regulations were never finalized, they've never really gotten to that point yet. So that's the good news, is they didn't get to that point. The bad news is we still don't have final regulations, and final regulations actually give us something concrete that we can follow in some bright lines. But we do have kind of a sweetener and some really good news, and that's that they have said that you can rely on the proposed regulations until they're finalized. And since they've dropped it a little bit from their agenda, they say every year they're going to pick it back up, but it doesn't happen. For the time being, we can rely on these rules, but they're not necessarily enforcing them in a strict way, which means this is a great time to make sure the cafeteria plans are being used the way they should, that compliance is good, and you can do that and do some experimentation without having a huge IRS initiative for catching people who are doing it wrong. There's two types of common 125 plans that you might hear of, and this is where I don't like these names. So we've got these cafeteria 125 plans, which is the same thing. We also have people often talk about POP plans and FSAs. So a POP plan is a premium-only plan, and basically what that means is that the plan allows employees to purchase insurance using pre-tax dollars, and it means it's in an insured structure. The other thing you hear is FSAs, and that's where you really get into the alphabet soup and the confusion. That's a flexible spending account. There's actually 3 types of FSAs that you can offer through a 125 plan: medical, dependent care, and adoption assistance. Medical and dependent care is what you most commonly see. Flexible spending accounts are designed to allow employees to put aside money and use it to spend on those specific items. You're not necessarily purchasing insurance. You're using the money to actually buy or pay for instance, a copay or a deductible or something that's not covered by the plan but is a medical expense or a dependent care expense. The difference here is whether you're paying for an insurance product or a self-funded plan that operates like insurance, or whether you're actually setting aside money to use directly instead of through an insurance arrangement. What's really confusing about that is that flexible spending accounts are not truly accounts. What they really are in most situations, you could have an account, but that's rarely done. What they are is they're accounting entries. So the money stays in the general assets of the employer, but when you get reimbursed by the employer, it's treated as coming from an account because you've already agreed to have your salary reduced by a certain amount in order to cover that cost. The real strength of cafeteria plans is the tax advantages, and there's tax advantages for both employers and employees. From the employee's perspective, the salary from the reduction from the flexible spending account and from the POP plan are not non-taxable. What that means, money that you're spending in order to buy benefits, as long as those benefits are, in fact, would otherwise be tax advantage. Now, what this really is, and this is where I'm going to get tax geeky on you. The IRS has a doctrine called constructive receipt, and the idea is even if you're using money to purchase something that would have it be tax-free, like health benefits, if you're able to get the cash first, or you're able to get the cash and then you choose not to get the cash and instead get the benefit, you get taxed as if you got the cash and then bought the benefit with after-tax money. Obviously, if you're paying tax and it's like a 20% tax rate, for example, you've got then only, if it's for every dollar, you've only got 80 cents to spend on the money. If you're able to buy it on a tax-advantaged basis, you can spend the whole dollar. So it's a big benefit to avoid constructive receipt. And what cafeteria plans do is they provide one of the only mechanisms for avoiding constructive receipt. There's also 401k plans, and you can also put away money for certain types of commuter benefits, but otherwise, cafeteria plans are the exclusive means of avoiding constructive receipt. That also means, though, that there will be a slight impact on Social Security benefits or other benefits that are based on what your taxable wages are, because your taxable wages are lowered. So you get the advantage of not paying the tax. You also get a certain amount of disadvantage by having benefits tied to that slightly reduced. Generally, the tax savings more than outweigh any reduction in benefits. And I say that generally is in, I haven't heard of a situation yet where that's not the case, but I can hypothetically think up some strange situations where it might not be a good idea. They're very few and far between. For most employees, it's a clear choice. You want the tax savings. There's also big advantages for the employer because the amounts that are contributed through the cafeteria plan are not subject to Social Security, Medicare, and unemployment. And in a lot of other states, there's some other payroll taxes that you're also avoiding. This is a huge portion of the cost of having an employee. So if you can provide benefits straight into the employee's hands without having it subject to this tax, you've just come out very far ahead in terms of your cost of compensation. So the tax advantages are big, and for both the employer and the employee. The employer is usually going to know that. The employees, sometimes it takes some education for them to understand what's going on and to really value the benefit that you're offering them. The key to running a cafeteria plan is you need to have a plan document. It is the one big strict requirement. It seems simple, and it is fairly simple, but it's the thing that I see most often as a problem. And the problem is that people just kind of assume you can pay on a pre-tax basis for benefits like health insurance, and you can't without a cafeteria plan. You need a formal document. And so a lot of smaller employers or employers that started out small and grew don't even recognize they need that plan document. They've just been going and operating as if they have a plan for a number of years. And technically, they're in violation of the rules. They've been under withholding. They've been for all sorts of payroll taxes, and they've got mistakes going back several years with penalties potentially mounting. This is one of the biggest areas that as a tax attorney and as a benefits attorney I see is employers coming to me without any type of plan document at all. So you might be in that situation. Hopefully, since you're the group that's dialing in for this call, you're not. But if you are, or if you talk to somebody who's one of your colleagues and they're in that situation, it's not a panic situation. It's a time to take a deep breath and take a look at what you sent out, because the proposed regulations allow some flexibility in terms of how you define the plan document. It doesn't all have to be in one place. It doesn't have to have a formal title on the top that says plan document. It needs to be a written description of these specific rules. And oftentimes, if you look at what you do have in writing, like enrollment material or communication to employees or a board of directors decision to offer certain benefits, or even sometimes applications that and contracts you've entered into with certain providers to provide either administration or even sometimes your insurance contracts, will include language that can serve when you piece them together as the written plan document. And so that's what I do when I have an employer that comes in with that problem. I try to find the pieces that make up the written description of what they're offering, put those things together, and then you want to formalize it, because if the IRS audits, it's a lot easier to give them something that says plan document on the front top and is fully executed than to have to scrap together all these pieces. But you can scrap together the pieces, and then you can memorialize that with a formal plan. And so if you don't have a formal plan document, you haven't executed it, or if you've got one that's very old, this is an important place to start. Once you have a plan document, you need to be operating the plan in accordance with the document and the regulations. So it's good to know what the plan document looks like so that you can actually do it correctly. If you don't have a plan document, technically the IRS is going to go back and say, all this money was constructively received, you should have withheld taxes on it, it was all taxable. Fortunately, there has not been a lot of IRS enforcement in that area, and so even if there's enforcement, what I would recommend is going back and trying to find the written records and putting in the formalities. As I said before, it's the exclusive means of offering employees election between taxable and certain non-taxable benefits. Taxable, I mean cash or anything else that's actually not exempt from tax, and non-taxable benefits. I'm talking mostly about welfare plan benefits under ERISA. These are health, disability. We'll go through a list of them. And also dependent care is another one, which is not an ERISA benefit, but is a non-taxable benefit. You need to have a description of the benefits, the eligibility rules, election procedures, irrevocability of elections, how the employer contributions are made, what the maximums and minimums are in the plan year, how your plan year runs. And for flexible spending accounts, you need use it or lose it rules and uniform coverage rules. There's some controversy about whether you actually need to lay all that out explicitly. Some practitioners and some plans have tried to incorporate it by reference. The IRS does not like that. They like it to be laid out. Probably, if you had to, you could argue that you would give it adequate notice of it through, in some cases, just a statement that you're following those rules. It's better to have it laid out, though, in simple terms. The reality is often the open enrollment material or other materials that you use to communicate to employees will contain most of these rules. The other big issue is that if you have a written plan, and you need to have a written plan, you really need to be applying it uniformly to all the participants. So if you have a similarly situated participant, that participant needs to be treated the same as any other participant. So you can't just say, Lori, for instance, gets a great plan and Jody gets a bad plan, unless there's something that you can concretely identify that makes Jody different from Lori, other than you like one more than the other. So that's really, a lot of the rules are aimed at that fair treatment.
Hey, Tony, I might have you, if you see, there's been a couple of questions come up. If you want to take a quick segue and address a question or two, or we can choose to defer those to the end if you'd like. But you should see in your chat a couple of questions came up.
I do see that in the chat the questions. I think what I'd like to do is defer it to the end, if that's okay.
Yeah, that sounds good.
Great.
No problem. We
have certain benefits that can be offered. Those are specifically outlined in the Internal Revenue Code. And this is a pretty comprehensive list on this slide. What you most often see is group accident and health plans, dental, vision, hearing. You don't see individual health policies very often, but you could offer them. These are policies that are targeted towards specific health issues like cancer or other types of diseases. Sometimes there's heart-related individual policies. You see that less often. More often, those are not offered through a cafeteria plan, but outside of the cafeteria plan, but they could be. It's a little more difficult. The health flexible spending accounts are very common. That's what you're most likely to see, but they are also dependent care and potentially adoption assistance. Group term life insurance for amounts over the $50,000 exclusion could be included. We'll talk about that in a moment. You also see short or long-term disability coverage. You usually don't see that offered on a pre-tax basis because once you aren't taxed on the amount of the premium, the benefits themselves become taxable, which is not usually what people want. They would usually prefer, once they're disabled, to be able to receive those disability benefits on a pre-tax basis, but it could be offered. AD&D is often offered. You also have health savings accounts, which can be offered through a cafeteria plan. That's a fairly new event that you can offer them. Offering health savings accounts through a cafeteria plan is something I highly recommend if you're providing HSAs. Running it through a cafeteria plan allows you to avoid the comparability rules and some of the more difficult HSA rules. HSAs are not ERISA benefits, but they provide the types of health advantages and tax advantages that make them attractive. Also, contributions to a 401k plan can be offered. That's a little bit interesting because the 401k plan is designed to avoid constructive receipt, and so is the cafeteria plan benefit. But you can provide that choice between cash, health benefit, or another type of welfare benefit, and the 401k, and have that an option within the cafeteria plan. As I said before, I think I might have missed a slide. I'm going to go back. Okay. One of the things that can also in a cafeteria plan is certain types of paid time off. This is difficult, and I'm not going to spend a lot of time talking about it, but it's difficult to offer paid time off in a cafeteria plan because you can't defer compensation in a cafeteria plan. That's a very strict rule. There's a few little exceptions, like certain benefits can have a 2-year period, or you can pay a premium that goes over into the next year, so you can pay for January's premium in December. But other than that, you can't defer compensation. And that means you can't use a grace period in your cafeteria plan and have paid time off. And it's also complicated because in certain states like California and Massachusetts, you can't have forfeitures. You have to have rollovers. And so really you don't see PTO in cafeteria plans for employers that have large operations in those states. So I'm not going to belabor this whole point. I will say, though, that if you are offering PTO in a cafeteria plan, if you're in California, probably stop and talk to somebody about it. If you are not in California or you're just doing it out of California, it's a good idea to talk to a consultant because the rules in terms of what amounts have to be used first in the ordering rules are fairly complex. Group term life insurance inside a cafeteria plan similarly is difficult and often not done because of the difficulty. You need to use the rules which are in a section of the Internal Revenue Code 179-3 in Table 1 in order to tax the employee on the premium amounts. And that's very confusing because it's not the premium amounts necessarily the insurance carrier is charging, it's the premium amounts that are listed in a table. And if you get it wrong, the life insurance, if there's a payout, it becomes taxable. So if you're going to offer that inside a cafeteria plan, I highly recommend, and I cannot stress this enough, talking to a consultant. If you have done it in the past, I highly recommend looking at it every year because what often happens is the premium amounts change in terms of what the carrier is asking for. And although it was set up correctly in the first instance, over time, the premium amounts change, and then you end up with a taxable event for an employee who or their family that's going through a traumatic loss, and they're getting hit with a big tax bill that you didn't even anticipate. And it's hard to unravel this. It's hard to get through it. So I don't recommend it generally, but if you do it carefully. What benefits cannot be offered? You cannot offer any individual medical insurance, and that includes inside or outside of Affordable Care Act marketplace. You can't offer MSAs. We talked about HSAs. You can't offer them, but if you've still got medical savings accounts left over, you can't have them. Group term life insurance and covering anyone other than the employee cannot be offered. Non-group term life can't be offered. Educational assistance can't be offered. That actually has its own code section. Same with scholarships, fellowships, and grants. Commuter transit benefit has its own code section. It does not belong anywhere near a cafeteria plan. You often see it in the plan document, and that's really okay. It's really just not being operated through the cafeteria plan, but you're making a cash or commuter benefit election. It's okay to communicate it to employees through it, but it needs to be clear that it's not really part of the cafeteria plan. Group legal, auto, homeowners, employee discounts, and any deferred compensation except the 401k that's specifically outlined in the rules can't be offered because there's no deferral of you can't have a deferral of comp, so you can't have any deferred compensation arrangement except for the specific 401k carve-out. Basically, participants have to be employees. Really, the spouses and dependents don't even really participate in most instances because it's the employee who has the salary that's being reduced. You can have certain types of retiree or former employee benefits, but it needs to really exist for active employees. You can cover them incidentally, but it can't be primarily a retiree or former employee program. Really, where you might run into this is when you have certain types of severance benefits that you're offering where you have extension of benefits. There are certain people who cannot participate. Self-employed individuals, partners, and 2% shareholders in the sub-S cannot participate, and neither can their lineal relatives. Even if they're employees, there is an exception for spouses of self-employed individuals. In other words, not partners and 2% shareholders, just somebody who's self-employed and then employs their spouse as an employee, that they can participate typically. Limited liability partnerships are different. There is an exception for partners who are employees. The key is, though, that they can't be entitled to guaranteed payments, and they can only participate with their employee compensation, so their W-2 compensation, not for any type of partnership returns. You also can't cover independent contractors who need to be employees, and you can't cover non-direct employees, and sometimes you see that happening. You see non-director employees. Although what I've seen mostly is problems with limited liability partnerships and what's a guaranteed payment and what's not. That's where you see most of the problems. The elections can only be made by the participants because they're the ones with the right to receive the salary. There's some limited exceptions when you have an employee that is a former employee or has passed away, and there are some exceptions, but they're fairly limited. The election has to be before the period of coverage begins, and that's a really important and strict rule that the IRS does require people to follow. But they've allowed in the proposed rules for a default and evergreen election, which I'll talk about in a moment. And it's important to remember, even when you have these default and evergreen elections, flexible spending accounts still require an affirmative pre-period of coverage election. It's very important. There is a requirement that the elections are irrevocable during the plan year, and that's the subject of a lot of administrative complications, and we will talk about that in just a moment. The default and evergreen elections have been specifically allowed in the proposed regulations, so new or current employees who don't elect can be given a default election for one or more qualified benefits. Usually this is something that it's sometimes done with 401k plans. It's also sometimes done, and I even think that it works well, and I recommend it for health insurance because it's difficult sometimes to get people to enroll in health insurance, and if you want them in the plan, it's important for you to have them in the plan. Having it as a default means that you've got them covered. There's not going to be a mistake where they're accidentally not covered. There's an evergreen election that's provided as an example in the proposed regulations. It's not the only example, but it includes a notice provision. It's not clear whether that notice provision is required, but it's useful in that if you follow it, you know that the IRS is approving of your structure. One of the really nice things about this is it's a good way to address newly born children. When you have a child that is newly born, particularly if you have preemies or complication during delivery or immediately after delivery, the parents are very stressed during that period and often forget to enroll their children on a timely basis. They do have a special enrollment right, but that special enrollment right has some strict parameters on when you need to actually do that enrollment. And not surprisingly, a lot of parents are more concerned with making sure their spouse and the child survives than filling out a bunch of paperwork. So one thing you can do is include an evergreen and default election so that newborn children are automatically covered and enrolled into your plan, particularly if you offer family coverage and there's no actual change in dollar amount. That's useful. And so I recommend looking at the default and evergreen election procedures to address the newly born children, because when you do have a problem with that, it can be tragic and it's usually upsetting for everyone involved and knows the family. There is the ability to do elections and disclosures in cafeteria plans using electronic means. These are the same rules for distributing summary plan descriptions that you might have associated with any particular benefit, so the insurance coverage. There are really three types for cafeteria plans. It's a little looser for cafeteria plans because it's an IRS type of plan and not a Department of Labor. The Department of Labor is a little more strict. You can have affirmative consent. This requires advance notice. There's also a rule that allows assumed consent, also requiring notice, but it's a little more lax. There's a wired at work rule, which basically means that employee has to access electronic information as an integral part of their job. And so anywhere they are where they're performing their duties, they have access to the electronic documents, and then you don't need consent. The problem with that is that if you have somebody on a leave of absence, or you have somebody who doesn't actually need electronic documents for everything they do, then that you don't have the consent, and so you don't have proper notice for them. There's also a special IRS rule that's an effective ability to access test, and it's a little more lax, but certainly the affirmative consent or the wired at work consent or wired at work process will meet that IRS effective ability to access the materials. From a cafeteria plan perspective, one of the nice things about the election rules is if you're doing online enrollment every year and you're going through that, you can put any type of disclosure you need and the elections into your online enrollment, and you know if they've actually enrolled, they've gotten all the documents. This can really streamline it. First of all, when they open it up, you can have them consent to electronic distribution. Since they're actually going and using an electronic process, you know they've actually got it. It meets the IRS ability to access test, and you know that they've actually affirmatively consented. They don't have to consent way in advance, just in advance. So it can be the first screen, then they enroll, and you've got your consent net. And that allows you to go and follow up only with those employees who can't go through an online process. So where you really see this as an issue is where somebody hasn't gone through the online process, or where you've got an evergreen election that rolls over from year to year, so they're not going through and electing every year. Elections can be changed only in very, very specific situations. So you'll have an open enrollment period. The elections are static through the plan year after that. You can change it for certain reasons. The biggest is a change in status. That can include marital, employment, number of dependents, and eligibility changes. In order to have a change in status be an election change, there's a consistency rule. And that means that the change has to be on account of and consistent with the change in status. The consistency rule sounds so simple, and I wish it was so simple, but it's an IRS rule, so of course it's not simple. It is complex in that what is considered consistent changes from benefit to benefit. I'll give you an example. So a flexible spending account medical election can be changed based on an employee no longer meeting eligibility, for instance, or a dependent no longer meeting eligibility. So you can change your pre-tax salary reduction election to be consistent with that. And the consistency rule would allow you then, if somebody aged out of needing the benefit, you could drop your coverage. What you couldn't necessarily do is add coverage. So when you have people being born or changing the number of dependents or changing what they might be eligible for, you can't change other things. So let's say you had a child. Now you need to cover somebody else and your costs have changed and you want to drop maybe coverage for yourself or have a reduced coverage to cover a different family member. You might not be able to do that. But if you're doing it for a health savings account, you can do it. Because when they look at a health savings account, they have a different rule, and pretty much you can make any change you want. So the consistency rule varies from benefit to benefit, and that causes a lot of confusion. It's a good idea to look at the rules, and oftentimes, if there's a complicated situation or a situation where an employee is weighing different decisions and making a change that isn't clearly, intuitively consistent with that change, then they may need help. And in that case, talk to an administrator, talk to a qualified consultant. I know that when I was talking to payroll system in advance of doing this, we were talking about the election change problems, and that's one of the biggest things that payroll systems feels in terms of the more complicated requirements in administering cafeteria plans. And asking for help may seem silly because the rule looks so simple, but it really isn't simple in application. There are also certain election changes specifically related mostly to health insurance, where you can enroll or disenroll because of special enrollment rights, judgments, decrees, or orders. These are qualified medical child support orders most of the time. Medicare or Medicaid entitlement, where there's no longer a need for coverage, and also certain specified cost and coverage changes, significant benefit or cost changes, and the taking of unpaid leave under the Family Medical Leave Act or similar unpaid federally protected leave. All of those things allow for changes under the specific terms of those rules. They don't have the same consistency rule requirement, and they're generally limited to the type of benefit where the rule applies. So it's a little different than the other rules. There are very few filing requirements for cafeteria plans because cafeteria plans really are a tax vehicle. They're not really a formal ERISA plan, so you don't have a Form 5500 or Schedule F filing, but you may actually be providing benefits that are an independent ERISA welfare benefit plan. And then you'll need to look at the Department of Labor regulations to decide if you need to file a return for that plan. Really, health flexible spending accounts is where you see that happen. So if you have a health flexible spending account and you're not otherwise filing 5500s for under some type of wrap structure, so often you have a situation where you have a flexible spending account and a medical insurance and maybe a self-funded medical and maybe dental, and you've got a wrap document, you're filing 5500 for all of that. In that case, you're just really entering a code to say that you have a health flexible spending account. You're not filing a whole separate Form 5500. But if you're not doing that and you have the health flexible spending account, you need to look at the 5500 rules and determine whether you have a filing need. You may not, because it may be small and it may be unfunded. There are also non-discrimination testing requirements under the cafeteria plan. I will say, though, before I even get into this, because this is a very, very brief overview of the testing requirements, that if you're a small employer and you want to avoid these testing requirements altogether, there is a cafeteria plan called a simple cafeteria plan, that as long as the employer is making a certain contribution on behalf of all eligible employees, you can avoid all non-discrimination testing requirements. And I'll talk a little bit more about that in a second. But there is a way to get out of non-discrimination testing for cafeteria plans. The cafeteria plan non-discrimination testing is voluminous and complicated. In a very simplified form, you need to show that you're providing non-discriminatory eligibility. So similarly situated people are able to become eligible, and also a contributions and benefit test showing that you're uniformly giving similarly situated participants the ability to elect taxable and non-taxable benefits, and the actual election of this doesn't disproportionately favor highly compensated participants. The reason why these tests are a problem to perform is not because they're so hard to pass. The cafeteria plan tests are actually fairly lenient. The reason why is because it's a bunch of number crunching. These are tax rules that have a lot of complication to them. They basically follow your 401k non-discrimination rules, but they basically follow it is a gross understatement, because they actually use a different definition for highly compensated, not because the definition is different. They use the same definition, but they are looking at a different period of time for testing. So you're looking at a different period for testing the compensation, and it doesn't involve the same look-back period. Cafeteria plans are based on more of a current year compensation, so you don't even necessarily have all the information when you're needing to run the test. The other issue with that is that the exclusions are different. So, and the testing is different. So there's a lot of, actually running the test is kind of hard to do. The other complication is that health flexible spending accounts are subject to 105H testing. And 105H testing defines highly compensated as the top 25% paid in the workforce, which is a totally different standard. So you have all these tests that involve all sorts of number crunching, and all of the tests are just a little bit different, just enough to make it problematic. Then, to make things matters worse, for 401k plans, you look back at a prior year, so you have all the data. You look at current data for this type of testing, and you test it on the last day of the year. And since it's the last day of the year, if there's a problem, there's nothing you can do to fix the problem. So for those employers that test, they usually try to do an initial testing early in the plan year so that even though they don't have all the data, it's a snapshot, it's an estimate, and if they're going to have a problem, they can correct before the end of the plan year. The other thing employers do to deal with this is, two things. One other thing is to set up a non-discriminatory plan in terms of your structure so that you don't have to worry really about whether you're passing because you know because of the way your plan is set up that you're going to pass. That leaves you less flexibility than you could otherwise have for carving out specific groups, but it simplifies your life because you don't have to really worry about the testing. The last thing some employers do is they use their 401k testing as a proxy, or if they have 105H testing, they use those two as a proxy to estimate whether they're having non-discrimination problems, and they only go through the more rigorous testing if they realize that there may be a problem. So all those things are ways to deal with the testing. And really probably design is what I see most. And I often get a question, can we carve a certain group out of our plan? And the answer is yes, you can, but if you carve them out, then you have this non-discrimination test issue. Where I really see the enforcement and I see the testing actually done is primarily related to dependent care assistance plans, because the test specifically has disproportionate favor to highly compensated participants that makes a lot of dependent care plans fail. It's common for dependent care plans to fail the testing. And so in order to avoid that and avoid creating taxable benefits, usually for the executives in the company, they'll do a mid-year test and try to adjust benefits in terms of that. And so that's most activity, and you actually see the most IRS enforcement. It's not otherwise an area that you see a lot of enforcement. But then again, most of the plans are designed to be fairly non-discriminatory on their face, which reduces the risk requirements related to it. So if you are in a situation where your dependent care is a problem and you're small, and it's often small employers that have that dependent care problem, I recommend looking at the simple cafeteria plan options and seeing if you can use a simple plan to avoid your non-discrimination issues for your dependent care assistant. So in summary, you have specific rules that need to be followed. You've got some flexibility. You also have a lot of non-enforcement recently, and you have the advantage that you have those proposed regulations out there that you can use to rely on. There's real tax advantages for both the employees and the employer. The more the employees have advantages, the more you're getting real value for your compensation dollar. You need to be following the plan document, which means you need to have one and you need to know what it says. If you don't, you need to take some steps to remedy that by going back, finding all your written material, and then memorializing that written plan that you've always had in place, but now you're labeling it clearly as a plan document, and you're labeling clearly the rules that you're following. If you have a flexible spending account that is a health flexible spending account, you need to be looking at whether you need to file a 5500, and you need to be looking at a strategy for non-discrimination testing or demonstrating non-discrimination prior to anybody asking about it and you having a problem with it. Know what your strategy is and be comfortable that you've got a strategy that's appropriate for your size and risk. And so now I will take questions, and I'm going to...
Yeah, I was going to say, Tony, why don't I let you take a quick breath. Go ahead and advance the slide to the contact information.
Oh, yes.
Maybe one more. And
if I don't answer the questions here, this is where you can look, but we'll try to answer a few of the questions as we're going
I think you can do it verbally. I'll So first of all, yeah, that concludes our webinar, everybody. Thanks so much for taking your time to visit with us. I think it was some nice information, Tony. Thank you. I think it was good introduction for those folks that are not that familiar with the Section 125 plans, and plenty of detail and some new information maybe for folks who are already working with these types of plans. We have displayed our contact information on the screen if you would like to continue the conversation either with us or with Tony. And what I will also we'll record the presentation. We'll be posting that online, and we can email you that as well. So that concludes it. Tony, go ahead and take a look at the questions, and you can respond either in the chat or you can respond verbally as well.
Why don't we go through some of the questions, because it looks like a lot